Europe has long been a trailblazer in sustainable investing. The region's deeply rooted societal and cultural values toward environmental protection and social responsibility have been the key drivers toward environmental, social, and governance, or ESG. This is also reflected through investor preferences as well as comprehensive regulatory frameworks that guide ESG practices. Public awareness about climate change, social inequality, and corporate governance issues has surged in recent years. This consciousness has led to an increase in demand in ESG investment portfolios for European investors who are seeking to align their investments with their ethical values. The European Union, with its ambitious Green Deal and sustainable finance strategy, has been pivotal in integrating ESG considerations into financial regulations. This makes ESG more than just a passing trend, but a fundamental part of investment strategy across the European Union with the aim of ensuring a sustainable future for all. As a result, Europe's investment landscape is changing rapidly. Financial institutions, asset managers, and individual investors are contributing to a shift toward more sustainable, responsible, and ethically governed portfolios. This is also having an impact not only on the investment landscape, but global markets as well. France, the EU's second largest economy, recently made a significant change to its ESG criteria for its socially responsible investment label. But how does this change fit into the framework for ESG investing across the European Union and potentially globally? So, what is socially responsible investing? Well, it, also known as SRI, are investments toward companies that are considered to have good social value based on the nature of the business that they conduct. These investments can be made directly into the company through mutual funds or through exchange traded funds or ETF. Now, some companies of note that are deemed to have good social value are outdoor apparel products company Patagonia, as well as Lego. France's label for socially responsible investing is called ISR, but a new ruling from the French government has mandated that the ISR label, beginning in 2025, cannot be applied toward investment portfolios that contain companies that are involved in hydrocarbon projects, coal, or unconventional hydrocarbons. This decision by France is more than just a policy change. It is a statement, and it will have a major impact on ESG investing across Europe and potentially globally. The thinking behind this change is to align ESG investing more closely to the Paris Climate Agreement that was established in 2015. But how will this change affect ESG investing across Europe, where potentially tens of billions of euros are impacted by France's new ISR requirements? Many ESG funds are pan-European, and the goal of ESG investing is to establish uniformity. The decision by France, however, may lead to significant fragmentation. An example would be a company that is involved in oil and gas exploration. So, for example, once an oil and gas field has been utilized to capacity, there is very little likelihood that that same company that's involved will not seek out another oil and gas field. So this creates a major challenge for ESG portfolio managers in terms of the balance of their ESG investments and those who are in potentially violation of France's ISR label requirements. The stricter rules unveiled by France Finance Minister Bruno Le Maire will send shockwaves across the European Union as it relates to ESG investing. And the reason is because ESG portfolio managers like to standardize their products as well as minimize duplication and costs while maximizing liquidity. These portfolios are typically originated out of Ireland and Luxembourg and passported into other EU member countries. According to calculations by Morningstar Direct, there are over 1,200 ISR labeled funds with a total value of 7 billion euros. 45% of the stocks held in those funds are in oil and gas companies. This also affects major ESG investors like BlackRock and BNP Paribas, who are now faced with some major decisions as it relates to France's ISR ruling. French oil major Total Energies is held by 161 ISR labeled funds with aggregate holdings of 2.4 billion euros or 1.6% of the company's market capitalization. There is another requirement associated with France's ruling, and that is for ISR funds to invest at least 15% of their portfolios in companies with carbon transition plans. Now, those plans must align with the 2015 Paris Climate Agreement, and the metrics associated with that transition will increase progressively over time. Another component of the ISR ruling is greenwashing. France wants to eliminate any perceptions of greenwashing. The thinking is to provide more guidance and clarity to retail investors. So, what's behind France's decision to change ISR criteria? Well, according to experts, the country feels that resources must be directed toward more green types of activities or more sustainability focused activities and less toward fossil fuel related activities. The country has long been a leader in sustainability, but they feel that the efforts toward climate change need to be stronger and faster. France's ISR ruling isn't just about divestment from fossil fuels, it's about transitioning to greener finance. Some industry players welcome the ruling while others have concerns, and that would be that the ruling will lead to limited investment options as well as increased complexity. So, share your thoughts on this ruling by France. Do you think that it will accelerate the transition toward green economy, or will it just add more fragmentation to ESG investing? Thanks for checking out this video. If you liked it, be sure to hit the like button. And if you didn't, let us know how we can do better. We'll see you in the next video soon.